On today's episode of In the Know, we'll explore how to track prepayments made to vendors in QuickBooks Online with ProAdvisor trainer Brittany Brown. The training she'll present is an excerpt from the Expenses and Vendors course found in our newly reimagined QuickBooks Online Certification Level 2. Brittany will walk you through deciding which method to use, using accounts payable, using other current assets, and reconciling and running reports. So with that, let me turn it over to Brittany. Brittany, thank you for being here.
Thanks for having me, Jacqueline. I'm excited about this topic. Let's jump in. So this is on how to track prepayments to vendors. So clients often need to pay deposits or make prepayments to vendors before receiving goods or services. We deal with this all the time as a firm that's primarily focused on e-commerce brands. Our clients often have to make prepayments to vendors that they're ordering inventory from. And this can be kind of a complicated process to execute on if you don't know what you're doing. And it can also be kind of a pain in the neck to keep track of. I actually learned a lot as I was preparing for this presentation on some great suggestions that Intuit has that I think are really great workflows. When our customers make prepayments to vendors, there needs to be a well-defined workflow to keep the books accurate. Other situations where you might see this besides the one that I already mentioned is, let's say that you're an interior decorator and that you're going to make a purchase prepayment for some furniture for a customer, and you're going to be incurring that expense upfront before you really have an opportunity to bill that customer because you haven't really done any work for them. Or you might have a construction company that pays a large deposit to one of their large subcontractors. Again, you're incurring costs upfront before you really have the ability to create bills and then to have those payments run through that workflow the way it normally would. This prepayment, some other words you might use that might make sense would be things like a retainer, a deposit, a prepaid expense, or something similar. In this particular course, we're going to use the term prepayment, and it basically means that money that's paid in advance of the services being performed or the goods being purchased. So your first task when you're deciding this is which of these two methods you want to use in order to enter the prepayment vendors into QuickBooks. You can either record them using accounts payable or you can use an other asset account. So what are the pros and cons of each of these? So the first one, which is using accounts payable method. You can track vendor prepayments by entering a bill or expense and coding it to the account accounts payable. This then produces a credit on a vendor's account, thus decreasing the amount they're owed, which you can then later apply to the bill. So basically what you're doing is creating a negative vendor account, which is why we call it a vendor credit, but really it's a negative vendor account. Now, one of the things that I learned when I was going through school is that kind of helps all of this make a little bit more sense is a negative liability is the same thing as an asset, and a negative asset is the same thing as a liability. So in both of these cases, they're both correct from an accounting perspective, because when we create a negative accounts payable, our other option is to create an other current asset instead. We're basically creating an asset, but by using the accounts payable account, it can make it sometimes easier to link those two pieces together. So when you record the prepayment, you should, if you're going to do it all correctly and perfectly at the end of the year, if you have accounts that have negative AP balance, you could make a journal entry at the end of the year to reclassify that debit balance for prepayments for accounts payable to a prepaid expense asset account if it bothers you at the end of the year to have a negative AP. If you have a negative AP because the prepayments exceed what you then owe, that can just look really bad on financials, and some tax accounts, it might raise red flags. So even though it's correct accounting, you might not like the way it sits. This option of basically reversing it with a journal entry is a completely valid approach. And then you would basically reverse that journal entry on the first day of the year. One of the ways to do this without having to create multiple line journal entries for multiple vendors that have negative accounts payable is you can just use one account called accounts payable adjustment and use that one vendor account on the journal entry when reversing the entry. Incidentally, this method does not necessarily conform to generally accepted accounting principles, aka GAAP, because of the fact that it creates the negative AP instead of the positive asset account. But again, it is actually correct accounting. It just doesn't quite look right when you're doing things like calculating current ratios. Like I mentioned at the beginning, a negative liability is actually the same thing as an asset and hits those ratios in the same way. So if you don't have anybody who's looking over your shoulder who actually cares about that, you can skip the step if you want, if it's too much of a hassle, because the accounting is correct. It just doesn't look quite as nice. So the other option, if you really want it to just look the way you want to, or if you have auditors that are going to push back on you, is you can use the other current assets account. So in this scenario, you're going to track vendors' prepayments by actually entering an expense or check or creating a bill and recording it to this other asset account, usually called something like vendor prepayments, or like if you want to be more specific and call it like inventory prepayments, if that's what it's for, whatever. Then you can increase the balance until you are ready to pay the final bill, and then you reverse that balance against the AP that's created when the bill's actually created. Now, I'm actually going to demo all of this, so if you're having a hard time following what I'm saying, like, yes, there's a lot of like accounting lingo that's going on right now, but in just a moment I'm going to demo it, and hopefully it will help make a lot more sense. The bill will then later be entered into the full amount of the goods and services, but we'll add a line for the amount of the prepayment. This will offset that same account used in the first transaction and will reduce the total bill due, showing only the final amount needing to be paid. Now, that was really a mouthful. So we're going to go to QuickBooks in just a minute to show you how this works. But before we go there, let's ask just a couple final questions when helping you determine which method should be used. You should be asking yourself questions like whether the financial statements are going to be needed by outside third parties, people like investors, or like if you have to be audited, or anybody like that. So if anyone else is going to be looking at it and they might have an opinion about it, that might affect the decision you make. Also, how often the client is making prepayments to vendors, how much the prepayments are, like if they're a material or immaterial amount, how much time will pass between when those prepayments are made and when the work is being done or the services are being delivered, which is again sort of like a materiality question, like is it a material time frame? If we're talking about a couple of days, maybe handle it differently than if you're talking about a long time frame. And the total value of combined vendor prepayments at the end of the year. In general, as a general rule of thumb, the accounts payable option may be acceptable if your client uses reports for management purposes only. So in other words, you are not providing these financials to somebody else who might say, why is your vendor balance negative? That doesn't make any sense. It actually does make sense, but might require a lengthy explanation that you might not want to give. So that's one reason to maybe go with the other route instead. Or when the total amount of prepayment is not a material amount, it kind of just doesn't matter. This method is best when clients only use vendor prepayments occasionally, and clients can also use this method if there's a short time between the vendor prepayment and the delivery of the goods and services. Otherwise, the other current asset method is likely to be the best fit. One of the reasons why I don't say just default to the other asset approach is because it can actually be kind of hard to keep track of like which vendors are associated with prepayments, and to remember to go back and apply them against the bills when you are using the other asset account versus when you are using the accounts payable account instead. That prepayment is already associated with the vendor in a way that's very easy to see when the rest of the process moves forward. So all things considered, the accounts payable is probably easier to execute on, which is part of the reason why we say, like, consider this method unless you have a reason not to, because it is actually easier to execute in the books than the other method. But let's go into QuickBooks and look what this actually looks like. One of the things you might want to do if you're going to be using this method is to actually turn on a setting that will help automate some of this. So let's go look at what that looks like. So we're going to come here to the general gear setting again, account and settings. This particular setting happens to be under advanced, and the one we're looking for is right here that says automatically apply credits. So if this isn't already say on, I would expand this and I would select it instead. But keep in mind that this actually applies to both the AP and the AR workflow. So if that's not going to work for you on both sides, then maybe skip the automation and just do it manually instead. So how this is going to work is, let's say, let's give ourselves a scenario. Let's say that we are, let's say that we're pre-buying some sort of furniture for a customer that we're going to be doing some decorating from. So I'm going to come in here and I'm going to write a check. So I walk into the furniture store and I write a check. So let's say I'm buying it from Computers by Jenny. She also happens to sell, furniture. So we're going to buy that from her. We're going to go to checkings, enter everything else. When we come down here, instead of putting in the expense, I'm going to map this right to accounts payable. And I'm going to say pre-purchase for client. And again, we really like the number 500. So we're just going to go with 500. So the key to this method, the key to doing this correctly is this part here, is that when you create this expense to begin with, you're going to go directly to accounts payable as the category that it's actually being billed to. Then you're going to create the bill afterwards. But this prepayment, the key is that we go to accounts payable. So the person we're going to be paying is Computers by Jenny, and I'm going to say save and close. So now at this point, we need to go and we need to actually create the bill. There's one suggestion I have, and that is that there's a setting that might actually make this process easier for you. So I'm going to come up here to Gear Icon, Accountant Settings, and this particular setting is under the tab called Advanced. So we're going to come here and it's right here. So I'm looking at this one that says automatically apply credit. So if this wasn't already on, then I would turn it on. But just keep in mind that when I turn this on, it actually does apply to both the AR and the AP side of things. And so if that's not going to work for both workflows, then go ahead and leave that automation off and just do it manually. So let's talk about what this would look like. So I need to go and I need to make this prepayment. I'm going to go in and I'm going to write this check. So let's say, for example, that I'm buying inventory from somebody, and let's say that I'm buying inventory from Computers by Jenny, and they have requested, let's say that I have issued a $2,500 purchase order, and that they are requiring me to give them a down payment as part of that. So down payment, retainer, prepayment, deposit, these are all basically the same thing. So I'm going to come here, and the key on this is to actually take accounts payable as being the account. So normally if I was buying inventory, I would not code this to accounts payable. But you have to remember, and I'm going to use the inventory example here because I think it's the one that has the most far-reaching financial ramifications. So I'm going to use that example here. If I was to instead indicate that this was inventory instead of accounts payable at this point in time, I would actually be increasing my inventory balance, which is not correct because I haven't actually, I've only put down a down payment on that inventory. I haven't actually received it, and I don't own the inventory right now. So it would actually be skewing my financials to code it really to anything else. But in this case, I'm going to code this to accounts payable, and I'm going to give this one $800, and I'm just going to save this. So what I have right now is a prepayment to this particular customer. So one of the things I want to show you guys before we move on is a report that will help us to kind of see the way that this is playing through. So what I have here is I have my unpaid bills report. Let's see, unpaid bills. So underneath this particular customer that I just used, Computers by Jenny, I can see that I now have two payments. I entered another one before this training began. So I have two prepayments that have been made, but no bill that's been established. So as you can see for this particular customer, I actually have a negative vendor balance, just like I said that we would. So this $500 prepayment and this $800 prepayment give us a combined prepayment of $1,300. And so this account, if I was to just run like a vendor aging balance, would show a negative balance of $1,300. And that is why some people don't love this method, because a negative vendor balance is normally like a red flag of there being a problem. But in this case, it's exactly right. They should have a negative vendor balance because I have overpaid for something I haven't even been billed for. But now how would we complete the loop on this? So the way that we would now complete the loop on this is we would come here to bill, and I would now enter the whole bill. So let's say after a couple of transactions and a couple of prepayments, that now the relationship is coming to a complete, and now I'm actually sending them the full bill. So let's say that it was for, and I don't think I have like a furniture option here, so I'm going to say instead let's go with computer rental, equipment rental. So now I have a full $2,500 that is now being billed. So this is an actual bill, and had we not made any sort of prepayment activity, this would literally just be just an accounts payable with the expense coded. However, because I do have a prepayment against this, let's go back and look at that report again. So I'm going to refresh the screen, and now we're going to see what happens with this report. So here inside this report, I can see that because I now have a bill that's been entered for this vendor as well as the prepayment, their balance as a vendor will now reflect both sides of this. So I'll see the increase of $2,500 for the bill that represents the entire transactional relationship for this. But I also now have these 2 prepayments that are on this bill as well. And I can see that I now have a net AP with this particular vendor of $1,200, which is exactly right. So now how am I going to close the loop on this? Because like what I really want to be able to do now is pay the bill, have those prepayments correctly applied, and have like the history of this vendor relationship be reflected correctly. So in order to complete the process on this, I'm going to come here to this new button again, and I'm going to say pay bills. And now as I come in here to pay bills, I'm going to say I have this bill that I want to pay. And you can see that it is automatically, because I took that step to automatically apply, it's now automatically applying these credits. If it was not in that, I'd have to do this manually, but it's automatically applying this credit. Therefore, the only remaining amount I have left to pay now is this $1,200, which is correct. So if I was to go ahead and save this exactly the way it's sitting with those 2 prepayments automatically applying, and I'm indicating that I'm paying a $1,200. Now let's go back. Oops. I actually want to save this. So let's say save and close, save and close. Now let's go back and look at this report one more. Oh, that's why. Okay, so I'm saying I'm paying this out of my checking account. So save and close. And now let's go take a look at this report one more time. And as you can see, in just a second after this refreshes, that there is that particular vendor doesn't even show up on this report anymore. So you'll see in just a second, it doesn't even show up on this report anymore. All of that prepayment activity, the bill that we entered, it is all netted against each other now. So when I went into that vendor to pay that bill, it automatically gave me the credit to apply. That is why this particular approach can be a lot easier to manage, because that prepayment is already associated with the vendor. So when I create a bill for the vendor, QuickBooks already recognizes that that vendor had a negative balance because of the prepayments. And so like closing the loop on that becomes a lot easier versus the method I'm just about to show you, which is using the asset account instead, which doesn't create kind of screwy results on negative AP balances. So, like auditors like it better, but it is actually harder to execute because of some of these other reasons. So this is a great option. If you don't have somebody looking over your shoulder who has an opinion about how it looks on your financials, you can see that was very easy to keep track of, and it was very easy to manage from beginning to end. Now let's take a look at the second method for tracking vendor prepayments, which is to record them to a vendor prepayment account, which is usually classified as an other current asset account. This will increase the balance in that account until your client is ready to pay the final bill. And then there's this nifty little trick you're going to use to apply that prepayment, reverse the prepayment as part of the bill. So there's a great audit trail against it, but it can be a little bit harder to keep track of. But let's jump into that and see what that looks like inside QuickBooks now. So in order to use this method, the first thing you need to do is you need to make sure you actually have the account that's going to be used in order to track the prepayment. So we're going to come in here to the chart of accounts, and I'm going to create a new account. I'm going to call this new account vendor prepayments. And as I mentioned earlier, vendor prepayments. As I mentioned earlier, this is going to be an other current asset account. So I'm going to choose other current asset here and other current asset here as well. And I'm going to save this account. So this vendor prepayment now is basically going to hold all the things that would classify as prepayments, meaning that these services and these goods have not been delivered, but I have now made a payment of some kind on it. So what will this look like? So after creating that asset account, the next thing I'm going to do is basically what I did last time. Is I'm going to say, who am I planning on paying? We favored Computers by Jenny last time. Let's use Books by Betsy this time. I'm going to indicate the account that I'm paying it for. And I'm going to choose here, let's say that we're doing some sort of office. Actually, no, sorry. This is where I'm actually going to put in the vendor prepayments. So I'm going to map this to this vendor prepayment account that I just chose. So I'm going to say prepayment, and I cannot type when people are watching, prepayment for order. Okay. And I'm going to say this is a $600 prepayment. So I issue the money, the check goes out, whether I'm paying with a credit card, however it is. The key to this method is this part here. So at the part where this prepayment is made, I'm actually going to map this to this vendor prepayment account. Now, what will happen when I save this screen? This is the question I always like to ask. What will be the financial impact when I save this screen? Is that my bank account will go down, my checking account will go down by $600, and this vendor prepayment asset account will actually go up. So I will now have this transaction. I will now have this $600 balance waiting to be used in the vendor prepayment account. I'm actually going to go back into this because I want you guys to get in the habit of thinking through the financial impact and to verify and to think through this, because I think it'll make everybody who's watching this just a much better accountant and bookkeeper to be aware of the financial impact of the things that you're doing. So when we hit save on that screen, we are creating on the financials a vendor prepayment account. If I do nothing with this, if I forget about it completely in the future, this asset called vendor prepayment will just sit there. And this is part of the reason why this particular method can be a little bit more challenging, is because it is very common for people to end up with these prepayment amounts that are just sort of trapped here. One of the things we're going to talk about as part of showing you this method is how to actually reconcile information to make this less likely to happen. But just know you have now created a $600 prepayment that's just going to sit on your balance sheet unless you do something with it. So what do you need to do with it next? So the next thing you need to do with this is you need to do the next step. So now Books by Bessie, we finished the job with her, and now she's billing us for the full amount. So we're going to come in here and we're going to create the bill and Books by Bessie. So Books by Bessie, we now are going, this is where we would now actually indicate the true expense that's being used. So let's say that we were hiring her as a bookkeeper, because that seems appropriate with the name Books by Bessie. And this is a $2,500 engagement. Now, if I was to just save this right now, and I was asking my class what the problem is here, the problem is that now I'm showing that I owe this individual $2,500, but this is not accurate because I've already made a $600 prepayment that needs to actually be applied against this bill. And so, but as you can see, one of the challenges that I mentioned with this particular process is that it's lost right now. I'd have to just remember that that prepayment is associated with this, and that this would now be the time for me to actually associate it instead of the system knowing that. Like when it did with the accounts payable, the system knew that I had a credit that needed to be applied. Now I need to remember that I have a credit that needs to be applied. But when I remember that I have a credit that needs to be applied, this is how this is going to happen. So I'm going to say vendor prepayment, and I'm actually now going to decrease this. This is going to be a negative amount entered for $600 like this. Now this is beautiful. And as I was reading through this, I was like, this is so great, really, because this is what happens from a financial impact now. I have an outstanding accounts payable now of only $1,900, which is correct because I've already prepaid. Also, this transaction, this line item now decreases that prepayment account. So if I was to go in and run a report on that balance sheet, I would see an increase and then a decrease into that very account. So this also removes that prepayment while also associating that prepayment with this particular transaction. So as long as I remember that I have a prepayment and I remember to apply it this way, it's a very nifty way. It closes all the loops. It closes all the pieces. The system just doesn't prompt you to remind you that you have a prepayment that needs to be associated with this, which is why this can be a little bit trickier to track. But now I'm going to save this. And on the back end, everything about this is now correct. So in order to make this process a little bit more usable, there's a really great way to basically reconcile and some reports that can be used to help you keep this prepayment account clean. So clients can run a report to view any existing prepayments in QuickBooks, and you would first reconcile this account using the vendor prepayment and then filter the report. Before running the report, reconcile that other current assets account in which those vendor prepayments are being recorded. And this account should be reconciled at least once per month to clear out any prepayments that have been fully applied. When reconciling that account, because you're not reconciling against a statement or anything like that, you're always going to enter its ending balance as 0, regardless of the actual balance, like in that reconciliation screen. The account won't be marked as fully reconciled until it's fully used up and the transactions have offset each other. Using the 0 amount here enables you to track the ins and outs. If the client has a large amount posted to a vendor prepayment account but pay in small installments, the transactions won't clear until the prepayment is fully applied, and then they can clear the bill against those installments. So to track the open vendor prepayments, you can run a detailed transaction report for the vendor prepayment account and customize it. Let's take a look at how to do this. So you're going to open a balance sheet and look for that prepayment balance account. Select the balance on the vendor prepayment account to open a detailed report. This is how you're basically going to identify what might still need some of your attention. You're going to customize the report first by changing the report period to all dates. Under the group by, you're going to select that vendor field. You're going to select the columns and adjust them by adding, removing, and reordering them as necessary. And from the filter option, you can open another filter and then select cleared and choose uncleared in the dropdown to only display the uncleared transactions in the report, which will be uncleared if you've done the reconciliation correctly, which we'll go over in just a minute. Change the report title to vendor prepayments by overtyping the existing title. And then save this customization so you don't have to recreate the report every time you or your clients want to go back and look at that open balance. Clients can also use these customizations to get reports on other balance sheet accounts. Like, this is a great method to use when the client needs to know what makes up the open balance. For example, I've seen people use this for employee advances and customer prepayments as well. And then you're going to run the report. So at the moment, you can see it's showing all prepayments, even those with the zero balance. Like I can see here, like this one here should be zeroed out because we had a prepayment and then we billed against it. And this one shouldn't be showing up. If we do this next step, which will then make this report even more effective. So to get the reports to show just open prepayments, we're going to actually reconcile the vendor payment account regularly, as I mentioned before. The beginning balance should be 0 here, and the ending balance should be 0. For the ending balance, you're going to enter that 0 regardless of what the balance is on the balance sheet account. Really what we're just looking at is we're looking at the ins and outs, and we want them to balance against each other, which is why we're going 0 to 0. You're going to enter the reconciliation date, typically done monthly, and then you're going to start the reconciliation. Then you're going to mark any prepayments that have been fully used. That is, the full amount of the retainer has been applied as cleared. One will show the payment column, the other in the charge column. When all the fully used vendor prepayments are cleared and the difference is 0, you're going to select finish now. So we see here money in, money out, money in, money out. When these are exactly offset each other, which is what we're really looking for, is things that have been fully used and offset, you'll see it balance to 0. So this is why we use the 0 balance, because we are basically balancing to 0 every time we do this. Then you're going to say finish now. Because you have customized the vendor prepayment reports by adding a filter for uncleared status, when you then turn around and run this customized report, you will now see that it will only show open prepayments, which is exactly what we want. We want to be able to say, like, oh, these are things that should still be on our radar. These are things we still want to be watching. And that's a wrap on how to track prepayments to vendors. Thanks for having me, Jacqueline.
Well, thank you, Brittany, for the presentation. And thank you for watching. Be sure to like, comment, and subscribe so that you don't miss a single episode. We'll catch you next time.